All right. What is up, tycoons? What's up, traders? Coming at you guys with a TLT update to start the week. And there's some very, very important charts and data that I want to show you guys that we need to look at before we dive into the TLT chart and really break down some of the day-to-day movements and look to see whether we're still tracking our patterns that we've been tracking the entire year long. So make sure to subscribe to the channel if you guys are new, smash the like button, and we'll go ahead and jump straight into it. What we're looking at here, this is going to be the National Financial Conditions Index and also the Adjusted National Financial Conditions Index. Okay, that's what this orange line is here and the red line is here. Jerome Powell and the Fed's job is to tighten financial conditions. That's what their main accomplishment and goal has been trying to be. Now, we've broken a major area here recently and headed downwards, and it's not a surprise to see the stock market trending upwards. That's what we're looking at down here. This is the S&P 500 SPX index. And what I want to show you guys and coincide with is every time there's a spike and a peak in financial conditions, you see a temporary bottom in the stock market, right? Over here, you see the stock market drops again as financial conditions tend to tighten more, and we get a peak over here and we get another bottom in the stock market. And sure enough, this is August right here, and Jerome Powell gave his famous Jackson Hole speech in August, and this is where financial conditions were at the time. Now, what's amazing to me is the Fed has increased rates by 275 basis points since then, since August 2022. And financial conditions, yes, they tightened after Jerome Powell gave his Jackson Hole speech, and we peaked again and we put in another bottom in the stock market. But look at what's happened. Financial conditions have actually eased. So it's really strange to me, and this is something that I'm paying a lot of attention to see, are we going to be able to continue and financial conditions continue to head lower while the stock market continues to rally and tries to recover? Or are we going to see financial conditions start to trend back up? Because remember, that's what Jerome Powell's goal is. Now, they are very focused on the labor market, and the labor market is showing signs of cooling off. CPI has been cooling off as well. We'll take a look at some of those things as well. But this is a really important chart to pay attention to whenever you hear him speaking of the financial conditions. The next one we're going to go to is this is the stock market versus stocks above their 200 moving average. So if we take a look here, the S&P 500 is going to be here in blue, and then this orange line is tracking the percentage of stocks above their 200-day moving average. Now, notice each time we get a peak in these, we also get a peak in the stock market, and we get a drop shortly afterwards, right? Now, look at what we've done recently. We've continued to get stocks, a higher percentage of stocks above their 200-day moving average, but the market is still making these lower highs, right? It's still in a downtrend of making lower highs. Here recently, our most recent peak was at the same level right here, and we see that was our most recent peak in the stock market. And look at where we're at right now. The percentage of stocks above their 200-day moving average is almost very similar to where it was when we got our recent peak in the market. So has all of this been one big bull trap, or do you guys think that the percentage of stocks above their 200-day moving average can continue to go higher and the stock market can continue to go higher as well? This is a good sign of momentum, right? It's showing that a large percentage of stocks have good momentum above their 200-day moving average. So it's going to be really interesting to see what happens, right? Are we going to try to peak out near these levels like we similarly did and create another lower high? Or is this going to be able to continue to push higher? And will the stock market continue to push higher as well? The next one we're going to look at is the stocks above their 50-day moving average. Now, the 50-day moving average is, a little more relevant towards the certain smaller time frame, right? So if we see here, there's still room to the upside, okay? We had our peak over here. We peaked out at a very similar level again over here, which that's kind of what we're wondering if we're going to do on the stocks above their 200-day moving average. But if you take a look, we peaked up here. The stock market peaked up here. We got to pull back. We've created a lower high, but at the same time, the stocks that were above their 50-day moving average was at a very similar level to what it was at this previous high over here. So are we going to see bullish momentum continue in the stock market, and will this continue to rise up, or potentially, is this thing starting to peak out, right? Notice we have this little range right over here. Okay, we're back at that range right here. There's a possibility we could top out, or we could come back up to these previous levels where we were at before topping out, right? It's going to be really interesting to see. And will this thing have a sharp decline again if it does peak out? Or will this thing just kind of gradually, stay up and in an upwards direction, maybe make a higher low, right? And do something like this along the way. That's going to be a good indicator of momentum in the stock market, and seeing whether we truly actually have some bullish momentum behind us, or if we have some bearish momentum behind us. Now this is the bond market versus stocks. Okay. And so the bond market bottoms first, right? We see that, and that's just some historical data, right? You're going to have the bond market bottom first, and then you're going to have the stock market bottom, and then you're going to see commodities bottom afterwards. Well, look at what we've got in here. Okay. We see the bond market is basically calling the Fed's bluff, right? We've seen financial conditions have loosened, and the S&P 500 is going up. A lot of the bond market in the stock market is basically pricing in a dovish Fed, and that the Fed is not going to hold true to his word and raise rates as long, or keep rates as long as he has said in 2023. And a lot of people are pricing in rate cuts towards the end of the year, right? And so that's what we're seeing right now. We're seeing, the bond market's outperforming the stock market right now. Down 5% versus the stock market down 11% nearly. And we see that, we bottomed over here. The S&P 500 dipped lower, right? So we had a double bottom here, but what we got was a bigger dip in the stock market. And we're seeing, bonds essentially, like I just said, they're calling the Fed's bluff. They're saying that the Fed is bluffing right now. And what we've done is we've actually gone higher than our previous highs, right? So notice how the stock market is here in orange. We have a high and then a lower high. Right here in the bond market, we have a high and a higher high. So will the bond market stay bullish, or could the Fed really throw a wrench in everyone's game plan in this next upcoming FOMC meeting? Now, the next chart we're going to look at is very important, right? And so what this does is this just visualizes and lets you guys know that the Fed has hiked rates in the past 8 cycles until the Fed funds rate was above CPI. This is the Fed funds rate currently, right? The Fed funds rate is at 4.10. If we go to the next slide, we'll take a look at CPI. CPI is dropping, and we can see that we have a clear peak over here, but it's at 6.5%. So if we go back to the next slide, to the previous slide, the Fed funds rate is at 4.10. And in the previous slide below or before shows that the Fed keeps hiking rates until the Fed funds rate is above CPI. So what that means is that CPI is going to have to drop dramatically, right? Even though we've already gotten a sharp drop, it's going to have to get below 4.10. Now, if they increase rates some more, whether it's 25 basis points or 50 basis points at the next meeting, that will make it a little bit easier for CPI to get below the Fed funds rate, but there's still some work to be done, right? They're not about to pivot anytime soon, or sooner than you think, right? It's actually going to be a little bit longer than you think, right? China is reopening right now. One of the major things that we've seen in bringing inflation down has been gasoline prices, right? And energy prices. Well, with China reopening, that could cause inflation to actually go back up, right? We could see inflation go back up in the next 3 to 6 months if China reopening causes energy prices, causes commodity prices, causes gasoline prices to go back up. And we see those things that really have a big weight and are a big factor in CPI. If those continue to head upwards as a result of China reopening, then that's going to be really interesting, and we could be due for some more pain in the markets. Now, China reopening doesn't have to increase inflation. All right. There's lots of analysts that are actually arguing the opposite. Okay. And saying that, hey, well, they've been on lockdown so much, and yeah, they have this excess supply, but the demand won't be there as much. The people are going to be much more reserved. They're going to, travel less. They're going to, not spend as much money in the markets, in day-to-day activities. But me personally, I see that as a less likely outcome, right? I think that, if China's reopened, They have so many people in that country. They're a huge major exporter, importer of the globe. You know, that's going to be a lot of energy consuming to get all of this work done, and it could bring those prices back up, and therefore it could bring CPI up. So you have to be cautious of that. Okay, if we look here, this is just a breakdown of CPI. The most recent CPI report, we can see, it fell 0.1% in December as gasoline decreases, right? That's the headline really behind it is gasoline, okay? Keep in mind what I just said about China reopening. Over here, we can see everything, and food and energy have been a big part of CPI basically, and so we need to keep a close eye on those. We'll hop into the next slide, and this is kind of just another way that you can measure the Fed fund rates relative to CPI. This has them both on the same chart, and what we want to see is we want to see this get back above zero, right? If this is above zero, which that's what this line is right here, this is the zero line. This means that the Fed funds rate is going to be higher than CPI. When this thing is skyrocketing to the downside, right, and really plummeting, that's when you're seeing that CPI is much higher than the actual Fed funds rate. Now, we've gone on the most aggressive rate cycle in history, or in recent history, and we're seeing that this is starting to move upwards at a very fast pace. But does it mean that, it has to continue heading straight upwards? Can this flatline a little bit and trade a little bit sideways? Or will this drop back down possibly if we see China reopening, causing inflation prices to come back up? That's some interesting stuff to look out for. Now, if you guys want to trade with us and be a part of our trading community, these are just some screenshots of our profits within the past few weeks of trading cycles, right? These are my trades. These are some of the admin member trades. These are member trades. We're making big gains in the market on a consistent basis. So if you ever want to trade with us, get my live market updates as well as the other admin trader live market updates and all of the valuable intel and data resources. Use the link in the description. There's a link to join the Discord. And if you use code Zackley, like the channel name Zackley Trades, you can get a discount on your membership. Now, for the first time in decades, Wall Street strategists see a down year for stocks, right? If we look at this, they actually see a down year for the stock market this year, which is really, really interesting to see, because currently we're seeing that the bond market calling the Fed's bluff and the stock market really reacting to the bond market. Okay, the bond market is much more massive than the stock market. Way, way, way more massive, tons more money in the bond market than the stock market. So the bond market often is a leading indicator, right? And that's why we make these TLT videos, because it's a leading indicator for the market. And so we actually have a lot of split views as well. So strategists are in disagreement on the stock outlook to a degree not seen in over a decade, right? This is a 30%, over 30% disagreement on what the market's going to do. A lot of people are really bullish, a lot of people are really bearish. Just depends on which analyst you speak on. But it's a 30% change. We haven't seen this since 09, right? We had the 08 financial crisis, and then in 09 people didn't know what the stock market was going to do. There was a 35% disagreement on what the stock market was going to do and what the highest and lowest price targets for the S&P 500 were. If we take a look at the next slide, this is actually going to be some of the top strategists / chief economists and the banks that they work for and their price targets, right? So we see Tom Lee. If you're not familiar with Tom Lee, I love him, right? But he is definitely a perma bull. Look at the price target that he's got for the S&P 500 in 2023. 47.50. Now, is that possible? That's definitely possible, right? Definitely possible. If you come down here, you can see P&B has got extremely bearish price target compared to that, right? 3,400 price target versus Tom Lee with a 47.50. And we can see there's a good majority of these are really hovering between 4150 and about 3900. This is what I would call the median range, okay, is going to be right around 4150, 4100 to about 3900 is where most economists and analysts are really seeing the market heading into 2023. So that's going to be it for our presentation. Okay, we'll go ahead and we're going to hop into TLT real quick. So we'll get right over to that screen. And what we're looking at is the daily time frame, okay? We've been tracking, before we zoom in a little bit, we've been tracking a much larger 5-wave move to the downside, okay? So we've been tracking this 5-wave move. This is what it looks like right here. You have 1, 2, 3, 4, 5, all right? And wave 1, wave 3, and wave 5 are 5-wave impulsive moves, while your wave 2 and your wave 4 are ABC correction waves. Okay, so if you visualize it, we have 1, 2, 3, 4, 5. That completes our A wave down. Then we got an ABC correction up, and we got a 1, 2, 3, 4, 5 down again, and then we got another ABC correction wave up, right? And we've started our wave 1 down. We got the bounce, right? We called the bounce perfectly. If you guys are watching these videos on TLT, we pretty much called the bounce perfectly. And a lot of people exited short positions right around this area. We were testing our trend line. We are completing our wave 1 down. So it made a lot of sense for us to get some type of a bounce upwards. Now the question is, will this rally continue, and will this void out our overall pattern, right? We're tracking this 5-wave move to the downside for the much larger 5-wave move. We've come up, and we could have completed our wave 2 right here. That's very, very possible. Now, to figure out if we've broken through this, okay, and if our wave 2 correction is going to be invalidated, there's some simple things that you can do. You can use the Fibonacci retracement tool. So the Fib retracement tool is going to give you 3 major levels that you need to pay attention to. They're going to be the 61.8, the 50%, and the 38.2. That's what we're visualizing right here using this Fib tool. Nothing moves in a straight line up, and nothing moves in a straight line down. You get a move up, retracement, continuation up higher. You get a move down, retracement, continuation down lower. Now you can spot a reversal, which is what we're looking to spot and paying close attention to currently. If you break through those retracement levels, right? If you do something like this and break through those retracement levels, you can spot a possible reversal. But the trend is your friend, and we have not had a reversal in the past year of trading. We've had a move to the downside, a retracement up to the 38.2, continuation down lower. Same thing happens over here. What do we get? We get a move down, we get a retracement up here to our 38.2 and 50% levels, and then we head back down lower. Same thing over here. These are our major resistance levels that we need to break through for reversals, right? We come down, we retrace up to 38.2, we continue heading down lower. And we've done this time and time again, right? And we also have this resistance trend line that we've been respecting very well. We broke out of it recently and found support, right? So over here, rejecting the 50% retracement line. Look at what we most recently did. We most recently broke out past this resistance trend line. Okay, we came up to exactly the 61.8% retracement level and finished our ABC move to the upside for this corrective wave 4, right? So now the game plan, okay, is going to be tracking this 5-wave move to the downside, but we have to be cautious and be mindful of a possible reversal, right? If we break out above the 61.8, which is going to be 109.72, there's a good chance we could come up and fill this gap on TLT, which is right around 111.42. Okay, if we're able to do that and flip this prior resistance point to support, so let's say we break out past it and we start finding support around here and continue heading higher, then this overall larger pattern we've been tracking will be voided out, and we could end up seeing a 5-wave move to the upside, an impulsive move to break out versus a correction move, right? So an ABC move is a correction, it's a corrective wave, meaning it's basically a retracement. Now, if this turns into a 1, 2, 3, 4, 5, then we possibly could be starting a new structure that we'll have to adjust and, really track forward. Now, things are still looking good on this 5-wave structure. If you noticed, we had some gaps up to fill, right? We had a gap up here to fill. We ended up filling this gap so we can go ahead and get rid of this drawing. And this is something that I was pointing out when we were down here. I said, hey, we're finding some support here. We have this trend line. We finished our wave 1 down, and we could come up and fill these gaps to the upside, right? And so that's what we've done, is we filled these gaps. Gaps fill about 90% of the time historically in the market. The big question is when, right? So when is this gap up going to fill right here towards 111? Is it going to happen sometime soon? And are we possibly going to break out of our bearish patterns? Or, is this gap going to take years to fill, if not months to fill, because we ultimately come back down and start filling our two gaps down we have to fill. We have a very big gap down on TLT it bottoms out right around 95. Okay, and then we have a very small gap down on TLT to about 100.5. So it's going to be very interesting. Are we going to get this 5-wave structure to the downside and continue heading lower? If we want that to happen, and if you're trying to short, you need to pay close attention to the MACD. The MACD gives you entry and exit signals, and it's one of the most important things that I look for before taking a trade. When we were in this ABC move to the upside, I wasn't aggressively shorting here. Just because we rejected our 61.8, I wasn't looking to aggressively short. I was waiting for the MACD sell signal, which we got right here at this point, right? And then afterwards, you see we got the sharp move to the downside. Over here, we're looking to see if we're going to bounce or if we're going to keep dropping lower and extend this wave one down. We found support along here, and then shortly afterwards, right here, we get the MACD buy signal, right? And after the MACD buy signal, we've had this large push to the upside. So if you're bullish on this, you can try to continue holding this, okay? But you need to be cautious if the blue line crosses below the orange line. If it does, then that's going to be a MACD exit signal, and it could signify that we're coming to possibly fill this gap or this gap to the downside. And if you're looking to short, I wouldn't try to go super aggressively trying to short anything, and rather wait to see, is this move going to push up higher, or are we going to get the MACD sell signal and possibly head back down lower? So that's it for today's video, guys. Okay. Hopefully you enjoyed it. Hopefully you learned something new. Smash the like button if you did. All right. It really helps out the small channel, and also subscribe to the channel. Okay. Because I'm dropping content like this every single week. I'm trying to give, the best TA videos that there are out there. Really giving you guys the signals, the different things to look for so that you can actually understand market price action and structure, versus just giving you guys some random support line to some random resistance line and then it not respecting those at all, right? I'm here to actually give you guys some good info that you can use. Now, remember, none of it is financial advice, but this is just all pure data. This is strictly charts. That's pure data. Charts are nothing but data and numbers. We're just seeing that visualized and going over some of the possible bullish and bearish scenarios based off the data presented. So that's it for today's video. If you enjoyed this video and made it this far, I really appreciate you, and you might enjoy one of these next two videos as well. So make sure to click on that.